Hello, and welcome back to the Accounting Podcast, your weekly roundup of news in the accounting profession. I'm Blake Oliver.
I'm David Leary. Blake, we're back, and a lot of news has happened. A lot.
A lot since we recorded just before Thanksgiving. We got to get through it all, so we'll get started right away. Our headline, Trump's Department of Education says that accountants aren't professionals anymore, but we're not alone. Nurses, I think, got left out as well. We'll talk about that and the AICPA and NASBA's response, as well as many other amazing stories in accounting. OpenAI is investing in a private equity firm that is investing in accounting firms. So we've got the biggest player in AI directly investing into private equity. David, anything else top of mind for you this week?
Your buddies at Doge are done. Doge is done.
Doge is done.
Doge is done. But that story kind of fell under the radar because I think this not a professional degree thing really got people upset. They missed Doge. And then Deloitte made more AI work slot, but this time for the Canadian government instead of the Australian government. So we can talk about that. And then some news about Intuit opening up small business data to one of the world's largest third-party ad networks. And then Intuit's raising prices on QuickBooks Desktop. Xero's raising prices on developers. So there's lots to talk about.
All right.
Where do you want to start?
Well, before we get to that, let's thank our sponsors this week.
Our sponsors this week, we have Cloud Accountant Staffing. We have the Association of Certified Fraud Examiners, ACFE, and we have OnPay.
And thanks to our live stream viewers who have joined us today. Feel free to put your comments there in the chat. Let us know what stories you think we should be talking about today that are top of mind for you as well. All right, David, let's get to it. The Department of Education wants to strip accounting status as a professional degree program. This would slash federal loan limits for accounting students from $50,000 to $20,500 per year starting in 2026. Why are they doing this? The Department of Education says that it is required by the One Big Beautiful Bill Act to identify eligible programs, and the negotiating committee proposed limiting professional degree designation to medicine, dentistry, law, and several other high-cost programs. The proposal excludes accounting as well as nursing, architecture, education itself, ironically, social work, engineering, physician assistants, occupational therapy, and audiology. The AICPA and NASBA have come out hard against this proposal. Mark Koziel emphasizes that recognizing accounting as a professional is common sense. He's the president and CEO of the AICPA, and he also is joined by Daniel Dustin, president and CEO of NASBA, in his opposition to this. Daniel Dustin notes that CPAs have been licensed professionals since 1896, which is a pretty long time. I think one of the longest licensed professions in the United States. Now, this would not generally affect undergraduate students, mostly graduate students. And I was following some of the commentary online about this on LinkedIn, and there's folks saying, well, who needs to spend $50,000 per year on education? I think people forget, though, just how expensive degrees have gotten. Costs can exceed $30,000 a year for some programs. So this could affect accounting students. But for me, I think it's more just a prestige thing. Like, if doctors and lawyers get counted as professionals and accountants don't, that's a problem.
And the way it's previously kind of been defined is if you have to do any post-secondary work. So 2 to 6 years usually says, okay, you've done post-bachelorate coursework, you're probably a professional. Like, that's kind of the loose definition in the past. But the issue with this is the bill did not spell out which professions qualify. So it turned into one of those, isn't the Trump supposed to get rid of the deep state where these government agencies are just making the rules? And essentially, they just told the education department to create a list on your own. And that's what they did. And so it's like, again, here we go with the government passes a bill, but it's not detailed enough. So the departments just have to make the rules up that, like, arguably the rules, is that really part of the bill? I don't know.
Edgar, in the live stream says, if we are no longer professionals, that means we are entitled to overtime. I'm good with this. Now, this is a good point. Under the federal overtime rules,
Fair labor, right? Yeah.
Fair Labor Act, professionals are excluded from overtime. And that's the justification for accounting firms, especially large ones, paying salaries and not paying their staff for overtime, especially the CPAs working for them. So, maybe this could be a positive change if CPAs start to get overtime finally for their 50, 60-hour
Yeah,
weeks.
that'll stop quickly. I imagine the firms will put pressure on AICPA, which will then have to finally put pressure on the legislature to get this changed. It's funny, when I was in Mexico, this was like the talk at Thanksgiving, the hot tub, right? There's a nurse in the hot tub, and I'm not a professional anymore. There was a lot of mocking it at some level, right? Like, I guess we're not professionals anymore. But I think that this is, the list is what's shocking people, but the spirit of this, I think, kind of makes sense, right? It's to like ensure colleges are not overcharging for these degrees, right? And the government doesn't have to eat loans if somebody gets a degree that's never going to be able to be paid off ultimately.
I guess, okay, I suppose that makes sense. But if you really want to bring down the cost of education, I mean, the way to do that is to stop subsidizing it. It's all this free money, or what is perceived as free money by students, that allows colleges to charge more because it's a supply demand thing, right? The more money there is available, the more people are willing to spend. So ironically, giving money to students from the federal government to spend on education actually increases the cost of education.
Yeah.
Same way that really cheap mortgages that are subsidized, guaranteed by the government, also increases the cost of housing.
So it feels like there was an attempt to do that, except for instead of making it globally for all degrees, they tried to stack rank what qualify, what's it's okay to give loans for, what's okay to be expensive and what's not, instead of trying to have a program to bring all costs down. But then the colleges would have lost their minds, right? If it was all degrees.
Yes, and the American Accounting Association, which is primarily educators, is also joining AICPA, NASBA, and state societies in calling on the Department of Education to formally recognize accounting as a professional degree program. And yes, this would definitely hurt those master's programs, and it's probably the last thing they need when states are moving to not require the fifth year of education as part of becoming a CPA, as the CPA pathway. All right, David, let's go ahead and thank our first sponsor for this episode, and it is Cloud Accountant Staffing.
Cloud Accountant Staffing. If you're thinking about increasing your team, or using remote team members, but you want to avoid the high-pressure sales calls and commitments before you even review possible candidates, good news, you can now review potential candidates without having sales calls or any commitments. Cloud Accountant Staffing has just launched their candidate profile, or candidate portal, where you can browse resumes, intro videos, assessments, and personality test results at any time of the day or night. No sales call, no pressure, no commitment. The candidate portal is updated daily. All the candidates are available for an interview within 24 hours. You can browse the candidates both by roles and experience. So if you want a bookkeeper that knows QuickBooks and has experience with nonprofits, you can drill down to find those candidates. How different would your firm look in 2026? And honestly, how would you feel if you could instantly add 40, 80, 120 hours of extra capacity every single week? To explore the new Cloud Accountant Staffing Candidate Portal, head over to accountingpodcast.promo/CAS. That is accountingpodcast.promo/CAS.
Let's talk about this AI work slop generated by Deloitte again. Now, not Deloitte US, but Deloitte in Canada this time. Last time it was Deloitte in Australia, I believe. So I caught this in the Independent. This is a major healthcare policy report that was commissioned by the Newfoundland and Labrador, is that right? Labrador government, that contains fabricated academic citations likely generated by artificial intelligence. It was Deloitte, and the report cost nearly $1.6 million. It was published in May, and it was the purpose of it is to develop a human resource strategy for the healthcare sector that is facing staffing shortages. And it is 526 pages. There have been 4 confirmed false references in the report about the cost effectiveness of certain monetary incentives. It has false citations about a paper called The Cost Effectiveness of Local Recruitment and Retention Strategies for Health Workers in Canada. Professor Gail Tomlin Murphy confirmed that the paper doesn't exist.
That's exactly what happened in Australia. They just created a paper that somebody never wrote.
And then there was apparently another citation about COVID-19's impact on workload and stress. And the hyperlink in the report leads to an unrelated article. The original paper cannot be found in academic databases. So, another, I guess, go ahead, David.
I think there's a couple ways to look at this. A, they're improving because in Australia in the summer, in July, when that news came out, they had 20 hallucinations, 20 plus, and now they only have 4. So they're getting better possibly at their AI. But the thing that I find kind of hilarious about this is Deloitte has a website set up, right? And they market their Deloitte AI and data team. So Deloitte should hire that team before they do any more AI work with clients. They're marketing themselves as AI experts, so companies can hire them to do AI correctly. And just go off their website, you get what you get from this team is you get a global AI and technology consultancy. You get insights from an ecosystem relationships. You get a Center for Sustainability and Climate Action. You get their AI trustee framework, and you get Deloitte's team of lawyers who help with AI compliance. So Deloitte has a team of AI and data people that in theory would prevent a company from making these mistakes Deloitte is making. I find that just very ironic. Like, use your own team. It doesn't make any sense.
We're talking about the Big Four, so let's talk about EY's new leader.
Before you leave on that, a quick follow-up of Australia. So the Australian Financial Review is reporting that the Deloitte partner that was in charge of the other AI problem that happened in Australia, he is now in the process of quote unquote retiring. So it looks like that he's being forced out, that partner.
EY has a new leader. Dante DeGidio has been nominated as EY's new U.S. leader after leading one of the most dramatic audit quality improvements in Big Four history. This was the guy who, under his leadership, EY slashed its audit deficiency rate from 46% in 2022 to an expected 9% or less in 2025. Those are the PCAOB inspection deficiency rates. That is a huge improvement, even if because you listen to the show, you know that the audit deficiency rate isn't exactly comparable across years.
Well, and not only that, it's hardly defined, right? Didn't you bring this up last week?
Yes. That's one of the problems with the PCAOB is that they've apparently never actually defined what audit quality means. They just look for deficiencies in the reports. But what is audit quality more broadly? Apparently, they've never defined that. Go listen to last week's episode if you missed that part. How did they do it? How did EY lower their deficiency rate? They basically fired a bunch of clients. They built centralized support teams, and they invested heavily in technology and training, as reported in the Wall Street Journal. So basically, the way I read this is that EY had a bad audit deficiency rate, and it was because at the time they had too many clients, and their staff and managers and partners were overworked.
Quality went down because you can't do both, right?
Quality went down, and so they shed clients. They tightened up on building these centralized support teams and improved technology, and they were able to get their audit quality rate down to one of the lowest. I think it might actually be the lowest of the Big Four.
It's interesting you say that, like they got rid of clients, because they never say who the clients are in these failed audits. It'd be interesting to see, is there a trend? Like that company moves to this auditor, to this auditor, to this auditor, and the same companies keep having these deficiencies, and it's the companies that are difficult or hard to work with.
Since we're talking about the PCAOB, let's talk about Christina Ho, who has been a guest on my Earmark podcast. She's a board member at the PCAOB, and she is resigning after serving as basically the only dissenter on the board in PCAOB history. And she helped to block several controversial audit standards. For instance, she voted against the NOCLAR standard for noncompliance with laws and regulations. That was ultimately withdrawn after widespread opposition from accounting firms. She also opposed the firm and engagement metric standards, which were later shelved as well. And she was the board member who engaged in a public dispute on LinkedIn with Senators Elizabeth Warren and Sheldon Whitehouse, who she said were persecuting her for expressing dissenting views on those firm and engagement metric standards, which the senators supported as a way to improve audit quality. And her resignation comes after a major shakeup at the PCAOB, following the departure of former chair Erica Williams last year. So we wish best of luck to Christina Ho in her future endeavors.
And this is has this fully rolled into the SEC? I can't remember or got confused.
How the PCAOB is organized?
Yeah, is it part of SEC now?
Well, no.
No.
The PCAOB, interestingly, is a nonprofit that is independent of the
that's what I
federal
always
government.
thought. Yeah.
And the SEC has established, Congress established the PCAOB as this nonprofit, and SEC delegates its authority to regulate audit firms to PCAOB and to do that, those reports, those audits of the auditors. And there has been talk in Congress, threats by Congress people to cut the PCAOB's funding, to roll it into the SEC. That hasn't happened yet. We will see what happens with the new leadership.
Yeah, the new chair of the SEC, Paul Atkins, he wants to replace all 5 board seats in 2026. So there's a lot of shakeup happening on this.
Now, here's the thing, though. The Trump administration is generally in favor of looser regulation, and we are seeing that now with the SEC considering loosening independence rules for Big Four accounting firms. They're thinking about revising these conflict of interest rules that prevent the Big Four accounting firms from auditing companies with which they have business relationships. And a big reason for that is this complex web of technology partnerships that have emerged in the AI era.
Yeah.
For example,
how does somebody audit Microsoft if everybody has Windows computers or everybody has iPhones, or how do you audit Apple? Yeah, exactly.
Well, and not just using their products. EY and KPMG are selling products that use Microsoft Azure OpenAI tools. PwC is OpenAI's biggest enterprise user and sells ChatGPT alongside their audit and tax services. And Deloitte is OpenAI's auditor. We don't know what they're doing in terms of that. So this is an independence dilemma, right? The current rules prohibit accounting firms from auditing companies whose products they use or resell. But there are only a few of these companies that make these enterprise products, and the Big Four all want to, in their consulting relationships with their clients, they want to implement these tools, resell these tools. So now, if they're all selling OpenAI products, who's going to audit OpenAI? Or who's going to audit Microsoft? And I'm just thinking about this from let's take a step back and just think about what this means, or does this make sense? It seems like a lot of the rules about auditor independence focus on these specific business relationships and, separating out, like if you have any financial interest in anything to do with a company, that is like a big deal. And they're very, very, very strict about this. But, is there a better way to ensure that auditors are independent? And maybe the answer is simply audit firms should not do anything else. Like if you actually want them to be independent, just have audit firms do audits. Split those out of the Big Four so there's not these consulting and tax relationships that could compromise auditor integrity.
Yeah, and you could even go even more weird meta on this. So if accounting firms are going to use AI tools to audit things, OpenAI technology is going to be used to audit OpenAI? This is even crazier, right? You start looping this through, but I don't know how you. There's too many connections and too many people use too many services. There's too many relationships. It's not as black and white as it used to be. I'm not sure you can solve this, Blake.
All right.
So
Well, go ahead, David.
I was gonna say, so when you interviewed Christina Ho, did you get any like vibe that like maybe she, because it was not too long ago, that maybe she's not happy being on the board, she maybe wants out, or does it feel like maybe she's forced out? What was your vibe on that?
I don't think that she was. My guess is she was not forced out. She's been there a while. She's been the dissenting voice. I mean, I would get bored after being there for that many years.
That's true.
So maybe it's just time to move on. She did her job.
And
All
so
right.
she was at Deloitte previously, right? Or no, yeah, I think she was
I
at
don't have
Deloitte
that.
back in the day.
It's not on my screen right now.
Okay,
I'll trust
gotcha.
you on that one. All right, David, let's talk a little bit about the economy because it is December 5th as we record this. We are going into the holidays. How are we doing? Where are we with all these tariffs? How's the job market looking? We've been talking all year about what is going to happen due to the tariffs and the economic impact. According to a report by the Tax Foundation published just before Thanksgiving, Trump's tariffs have actually been not as bad. In their words, or maybe this is my words, I guess. Trump's trade war bark was worse than his bite. The average tariff rate under the IEEPA was threatened at an average of 23.2%, but the actual weighted average rate is 10.8%. China got the biggest break. There was a threatened 145% tariff, and that's down to just 20%. And so the good news is that the economic damage is going to be smaller too. The Tax Foundation calculates that GDP is now projected to fall 0.4% instead of the originally estimated 0.7% hit. It's still not great for the economy, but it's better than it could have been.
So what was the average tariff rates before? Was it around 10% or just under?
Well, the target tariff rate after all of the Trump administration announcements was 23.2%.
Yeah, that was the
average.
new target. But what was kind of the old historical number?
I don't know if there really was a number. I mean, remember Trump was threatening these reciprocal rates that could be as high as like 100%.
Yeah.
I mean, basically like forcing us to not buy goods. And we still haven't actually had the Supreme Court decision. That should be coming soon that will determine whether or not these tariffs are legal in the first place.
I'm going to ask
So-
ChatGPT fast. Historic
Go for it.
average tariff rate for the U.S.
So the economy does seem to be slowing. There's a lot of mixed data here. There was a not a great payroll report from ADP for November. Small businesses lost 120,000 jobs. Large companies, though, added 39,000. Those are companies with more than 500 employees. So small businesses got crushed, lost over 100,000 jobs. Large companies added tens of thousands. It's ADP's chief economist says that small businesses are struggling with an uncertain macro environment and prices that have jumped 25% over 5 years. And inflation does seem to be remaining stubborn due to those, in large part, to those tariffs. 3 in 10 companies plan to conduct layoffs during the holidays, according to a story on CPA Practice Advisor that cites a resume.org survey from November. This was a survey of over 1,000 U.S. business leaders. So 3 in 10 companies are going to lay off workers before year end. 57% plan layoffs between Thanksgiving and Christmas. And 43% will cut jobs during the week between Christmas and New Year's. I always thought that that's like an awful time to lay people off. Like, why would you do that?
Well, I also think that's like probably a deceiving number because there's probably retail places that once Christmas is over, you don't need those employees anymore. And I wonder, like everything needs context. Like what are those exact numbers and who are these companies that are laying people off? Like 3 out of 30% of all companies are going to lay off people.
3 in 10.
Or intend
30%
to?
of U.S.
Yeah.
companies plan to lay off workers.
But how many? Like it feels like
Yeah.
these surveys are a little broad. I do have the historic tax rate So post World War II was roughly like 5 to 7%. And then in the modern era, so like 1990s through pre-Trump, it got down to somewhere in like 3.4, 3.5% is
The
probably the
tariff rate
historic rate.
overall.
So Trump did raise it by 3, but you're right, it's not what his bark was, right?
Yep.
So it went up 3x, which is still pretty significant if it's hitting 10% target now.
Here's a little bit of good news. This is a survey of CPA business executives by the AICPA. This is their Q4 survey. And the result is that CPA business executives are feeling worse about the US economy, but more optimistic about their own companies. Only 28% are optimistic about the economy. That's down from 34%. But 41% are bullish on their own company prospects, which is up from 37%. So I suppose that's some good news, because when executives are bullish about their own companies, I think that in general translates more to, positive outcomes, because people can be just negative in general, right? The same way that voters are negative about Congress, but are positive about their own representative. So you have to really think about, what are we asking? Tariff uncertainty is easing, according to this survey. Only 49%, that's still a lot, report significant uncertainty from tariffs, and that's down from 58% last quarter. But still, half of CPA business executives report significant tariff uncertainty. About half, a little less than 50%, are planning to expand their businesses, which is up from 46%. It's at 48% now. It was 46% in Q3.
And these are just CPA firm leaders around their own business.
No. These are CPAs in private industry.
Oh, in
That's
private
my
industry.
understanding
Gotcha.
of it. Yeah,
Got
CPA
it.
business executives. So Americans are likely to tighten their belts this holiday season, according to a report by the Conference Board. This is the Conference Board Holiday Spending Survey. Americans are planning to spend $73 less on holiday shopping this year compared to 2024. The average consumer intends to spend $990 on holiday purchases. That's down a little less than 7% from last year. But interestingly, it's not low-income families that are driving these cuts. Consumers earning over $75,000 are reducing spending the most, and those earning under $50K actually plan to spend slightly more. The only age group planning to spend more both on gifts and holiday items this year are people over 65. I guess those gifts for the grandchildren are very important.
Yeah. All the ones that got to ride the wave of market going up, housing prices going up, they got in when it was cheap.
Black Friday sales jumped this year. They went up 4.1% despite all the economic anxiety. Online sales were up 10%. In-store sales rose 1.7%, but the retails had to work harder for it. Shoppers said deals seemed weaker than last year, and stores were giving away a lot of free stuff. And I myself took advantage of some serious discounts. So we'll see if that good news about Black Friday translates into sales the rest of the month, so that those retailers can get into the black.
Yeah, people are very motivated by that Black Friday, Cyber Monday type stuff. Even us at Earmark, we did a Cyber Monday sale, and it was monstrous. People love it when you get 50% off. They love it. And but you can only do it one day a year. We can't do it forever.
Matt in the YouTube chat says, I don't get what use there is from economic surveys. They can be very easily manipulated. And I agree with you, Matt, which is why I like to read a lot of different surveys and try to synthesize what is happening based on what all the different data points are saying. The same way when you look at an election, you don't just look at one survey of voters, you try to aggregate them. That's been the trend over the years with sites like 538 and things like that. All right. Here's one more piece of economic data that is a little bit distressing, I guess, or maybe it's just a social change that's happening. And I think this has to do a lot with the cost of living. David, 1 in 3 young professionals are still living with their parents. And nearly half are living with families. So it's 34% live with their parents, 11% live with other relatives. And why is this happening? It's because of 62% cite high rent and housing costs. That's mainly it. And then there's some other smaller reasons like the salaries are low. They're saving for money, but it's really just high rent slash housing costs. That's incredible. That's a big change for our culture that basically nearly half, well, it's 45% of young professionals are living with relatives. That's according to the Boomerang Kids Report by Zeti, which is a resume template survey. They surveyed 1,000 adults aged 18 to 33. So these are professionals that are basically mostly in their 20s.
So people whose resumes have worked and they got a job, but they're still going to live at home.
That's right. And it's because the rent is too damn high.
Do you want to do our next ad? And
Let's
then
do that. Yeah,
talk
I
about
will
OpenAI?
go ahead and thank our next sponsor, which is ACFE. Ever wonder how much fraud is really costing your organization? According to the Association of Certified Fraud Examiners, companies lose an average of 5% of their revenue to fraud every single year. That's 1.7 million per case on average. But here's the kicker. Organizations with dedicated fraud teams cut those losses in half and catch frauds twice as fast. That's where the Association of Certified Fraud Examiners comes in. As the world's largest anti-fraud organization, they're empowering professionals like you with the tools, training, and credentials you need to protect your organization. Whether you're in accounting, compliance, internal audit, or fraud investigation, ACFE membership gives you access to cutting-edge resources, exclusive webinars, and a global network of over 95,000 members. Plus, you'll save 20% on all training and products and gain access to prepare for the prestigious Certified Fraud Examiner credential, the only one of its kind in the world. To learn more about ACFE membership and receive a free ACFE webinar, head over to accountingpodcast.promo/ACFE. That's accountingpodcast.promo/ACFE.
So let's talk OpenAI. And we'll kind of rewind a little bit. A few months back, I want to say April time, Thrive Holdings, which is part of Thrive Capital, made an investment into Crete Professionals Alliance. So Crete Professionals is a roll-up of accounting firms. And their stated mission is to roll up accounting firms and then force them to use technology, including AI. Right? So you have this roll-up that has an investment from Thrive Holdings, who now Thrive Holdings just took an investment from OpenAI for an undisclosed amount. And it involves two things. One is to accelerate the adoption of AI in the industries like accounting and IT services. But not only is OpenAI now investing in accounting firms, right, which ultimately firms are forcing to buy AI stuff, OpenAI is also going to embed teams directly inside these Thrive-backed companies to improve speed, accuracy, and cost efficiency. So OpenAI is going to help run accounting firms as well. So they're putting money in to be the technology, but now tie this back, right? Because I think when I tweet about this or I put it on social media, people don't get it. But this would be like Intuit Ventures, right? Buying accounting firms and making them buy QuickBooks and use QuickBooks. And people would lose their minds if that happened. But now I think about this more like if Intuit's paying OpenAI $100 million a year now, isn't there going to be some pressure somewhere for OpenAI to put pressure on Thrive Capital, put pressure on Crete to force those Crete professional firms to use QuickBooks? Like if you start follow the money, not the
Yes.
at the end of the day, follow the money.
And it's a circular trail of money. That's what TechCrunch called it. Rebecca Bellin in TechCrunch described this deal as a circular deal. And that's been the term that I've heard a lot in all of this talk of an AI bubble, is that you have these AI companies investing money in each other and making deals with each other. What does that do? It pumps revenue on the P&L of all these companies, but does that money and investment actually make it out into the real world and then generate returns? And so this could be that sort of like circular deal where the portfolio companies, like you said, they now buy OpenAI products and subscriptions and basically funded by OpenAI's own money. right?
Yes.
So OpenAI takes money from investors, invests it into private equity, which then pushes it down into their portfolio companies, which then use that money to buy OpenAI's products.
And this is
So
their stated goals. Like this is not even a hidden thing. Like that's the stated goal of professionals. Like that's their goal. Now it's funny you used the word circular because I wrote that down too. I think that I wrote down this is a circular mess, and I actually think it's going to explode soon. But the peak is probably my prediction. This is just a prediction. In 2026, I bet you we see an AICPA/CPA.com OpenAI partnership. And I have no inside information. I have no clue. I just based on behaviors of history. Do you remember we went to the AICPA Engage conference in the heyday of crypto and blockchain?
yeah,
And
yeah,
in that
yeah.
huge, I'm not positive of which crypto company it was, CoinTracker possibly, but they were the top sponsor at the conference. They had the biggest booth, but they were so half-assed they didn't actually have a booth. The masking tape was on the floor, but they never actually brought a booth. So they just had like a couch, and that was it. Because they didn't know they were supposed to build a booth for an accounting conference. But AICPA took the money. AICPA.com took the money, right? And so I would not be surprised if we see some huge OpenAI money going into AICPA or CPA.com. It's just a prediction in 2026. Do not be surprised to see this. There's just too much money, and AICPA and CPA.com are smart. They're going to go get some of that. The money's just sitting there for the taking.
Since we're talking about these AI companies, David, let's talk about some of the new features that have come out in the last month for accountants, for finance departments. Anthropic has launched Claude for Excel. This is a beta release. It came out in late October, and it allows for direct AI interaction within Microsoft Excel spreadsheets. Claude can now read, analyze, modify, and create workbooks with full transparency of changes. It rolled out initially to 1,000 beta users, and I assume it's going to roll out further. I don't think it's in public release yet. So we're starting to see this happen where these AI companies are not just building chatbots, they're actually building plugins for the tools that we're using that enable the chatbot to then click around inside of the app and do work for us. And that to me is very, very exciting and powerful.
How does Microsoft let this happen? And when I mean say let it happen, like they already had their own AI, they have their Copilot, they have Excel. How did they not build this first? It's kind of crazy to me.
It's
or
nice.
Prevent others from doing it.
It's funny you mentioned that because Microsoft has also launched an AI-powered finance tool for Microsoft 365. It's called Microsoft Copilot for Finance. It's in public preview, and it's an AI assistant that integrates directly into Excel, Outlook, and Teams. It also connects to financial systems such as Dynamics 365 and SAP. Key capabilities, examples, automated audit and reconciliation. You can now pull and reconcile account data with a single prompt. They claim that it will reduce data reconciliation time from 1 to 2 hours to 10 minutes per week. It can automatically identify inconsistencies. And they're saying they're seeing a 22% cost savings in average handling time based on their pilot. You could use it to streamline collections processes, enhance financial reporting. Basically, you can interact through natural language prompts directly in Excel and then ask it to pull data from different systems, update data back to source systems, manipulate the data in Excel. So think about this as like having a financial analyst inside of Excel now that can do work for you that you previously couldn't do if you didn't know all these Excel wizardry type of actions.
And I think we previously showed how some of the Gemini AI was in Google Sheets now on fields. You kind of type what you want the field to do, and then it goes and creates the formula for you. I think you showed some of that in the past. So good.
Well, shall we keep on with app news?
Yeah, I was going to jump into Xero. So this
yeah.
ties to what you're talking about. So Xero is raising prices on developers. Exactly, pretty much the same way Intuit did. But Xero, they actually are fessing up and saying it's to stop AI models, from accessing the data. So they're going to have a consumption tier. The more data you suck from Xero, the more you're going to pay type of a model, which is exactly like QuickBooks. And they released their updated terms of service, and their terms of service now includes new rules around AI, and they specifically are prohibiting developers from using the Xero API to train machine learning models. So I think we read between the lines on the QuickBooks price increases on this, but now it's been confirmed because Xero actually has said it, and they're explicitly banning this. A couple other changes they're doing, which I find is interesting. They're going to not allow apps to use bots or browser extensions. So a really useful tool like Write Tool that adds on to QuickBooks through a browser extension cannot exist in the Xero ecosystem, which will help, that prevents solutions from getting to the market. Or like this Claude thing with Excel. Based on Xero's rules, a tool like that cannot exist with Xero. So they have the new pricing model. The pricing page is out there. They have 2 webinars coming up, but people got very upset about this. I didn't realize how many, I think from my ecosystem days with the QuickBooks App Store, I got connected with lots of developers on the Xero ecosystem, and they are not happy on LinkedIn. The amount of posts, for some, this is going to kill smaller apps for sure. It's exactly the exact model as Intuit. They have a free tier, but it's so little, like it's for like 5 connections. So it's an internal app basically.
So I'm glad you brought up Xero, David. Sorry, you were going to finish. I cut you off.
I thought there was one more thing I was going to say. Just effective date. So effective December 4th for all new developers. So that was yesterday. And then March 2nd for existing developers, the new terms.
I'm glad you brought up Xero because I just got access to a new feature inside of a few of our Xero organizations. They now have auto reconcile, an automatic reconciling option feature that is powered by AI, which they call JAX, J-A-X, Just Ask Xero. And I turned it on. And now what it's doing is it's monitoring that bank feed inside of Xero in the bank account, and it will automatically reconcile transactions where it has a high confidence that there is a match or that it should do something based on historical data. And it's done it so far for 3 transactions, just a small start, but it did successfully code a transaction based on historical, like a credit card charge. And it also successfully matched 2 payroll transactions. So another way to think about this is that it's going and clicking OK to match.
That's what I was just going to ask. Is it just matching? You still have to go and confirm, or is it actually clicking it's a match?
It's clicking the OK. It's doing the individual transaction matching. And then there's a screen now where you can see all the reconciled transactions and see which ones were reconciled by AI and why, whether it was historical or it found a match. Now, the one thing that is missing, and maybe it's there, I just haven't seen it, is a rationale. So when I click on that row where it auto-matched, I want to know why. What was the logic that the AI used to match the transaction? Or what was the logic for coding a certain way? And I don't see that. And that is disappointing.
It's not even the generic, based on your history, we did this.
It says history, but it doesn't say like, we found
the logic is.
We found, 10 transactions over the last X months that are coded this way. Like, I want to be able to see the audit trail of what the AI is thinking. And I know that's there because all the reasoning is there. When you use ChatGPT via the API or you use it just in the web interface, you can see its thinking.
Yeah,
the thinking is available
discloses
now.
It to you as it goes up the screen.
So I would like to be able to, for every transaction, see the logic so that I can then fix it or audit it myself.
Is there an undo button?
You can go in and fix it if you need to. You can click through into the transaction, unreconcile it.
Okay.
Yeah, edit it. More Xero news. XeroCon is coming back in 2026 with events in 2 cities. London gets XeroCon July 8th and 9th at Olympia, London. And Denver, here in the US, is getting XeroCon on August 19 and 20 at the Colorado Convention Center.
Wasn't Denver the very first U.S. XeroCon?
No, the very first one was San Francisco.
Okay.
But that was very small. That was like 100 people. But and they have done Denver before, and I think it was at the Colorado Convention Center. That's a great location for it, very central. So the Denver tickets are going to go on sale in January, so look for those. That is always a fun event. And David, you and I are going to do our best to get out there. We always try to go to both XeroCon and QuickBooks.
Denver should be easy. London would be great. Denver's easy.
Yeah. So anyone from Xero listening from Xero UK, let's get us out to XeroCon London. That'd be fun. Okay.
I have 2 Intuit news if we want to pivot to that. And then or should we read our ad and then do that?
Let's thank our next sponsor for this episode, which is OnPay. Forbes and CNBC rank OnPay number 1 for small business payroll. OnPay really knows how to get payroll done right for every client you serve, no matter how complex. Their software is easy to use and backed by outstanding service levels. They handle new client onboarding for free and have experts on call to keep you and your clients on track. The system includes multi-state payroll, local tax filings, integrated HR tools, and more with no hidden fees. When you join OnPay's partner program, you get a custom dashboard to easily manage all your clients in one place. Plus, you can gain exclusive perks like revenue sharing or discounts, free payroll for your firm, co-branding opportunities, premium swag, and more. OnPay helps you run your practice efficiently while providing exceptional payroll that your clients can count on. And for a limited time, OnPay has a special offer just for accountants and bookkeepers. Here's how it works. If you add 3 clients and run payroll by January 31st, 2026, you'll earn $1,000. Then for each additional client, you'll earn $200 for a maximum total payout of $10,000. Wow. To learn more about how you can earn up to $10,000 when you switch clients to OnPay, head over to accountingpodcast.promo/OnPay. That's accountingpodcast.promo/ONPAY.
So Intuit is raising prices on QuickBooks Desktop effective February 1st, 2026. So they are going to raise Desktop Premier and Pro is going up, Desktop for the Mac, payroll is going up. They're going to start charging for QuickBooks Enterprise the number of employees you have. But all this is, the reason why is they want to eventually kill Desktop, right, and shove everybody to QuickBooks Enterprise. So they keep raising the prices on that. But I also think it's tied to, as Intuit gets everybody into the cloud, now you have this data that you can monetize. So some other news about Intuit that came out. Intuit created a thing, I covered it about a year ago, something called SMB Media Labs, where it was starting to aggregate data about small businesses, right, for marketers.
Mm-hmm.
But now they're going to open that data up and make it available on one of the world's largest third-party advertiser networks called Trade Desk. That's going to give advertisers far more accurate access to verified small business decision makers. So basically, you're taking Intuit's insights with the Trade Desk ad buying program. So if you have, some app or some company and you want to sell to small businesses, you're going to be able to target those ads really well now because the QuickBooks data is being shared with the third-party ad platform, like your client's data. Basically, how it works is the advertiser sets a goal, right? So I want to get app installs, or I want to reach small business owners. Then you can choose Trade Desk individual lists, but then you can also add on, also use Intuit's list of possible customers that are small businesses. And then it optimizes the ad millions of times a second and serves up the ads all over the web. And then they get bid up these things. Now, on one hand, I'm kind of like, F Intuit. Intuit's evil for doing this. Like, that's kind of the vibe. But on the other hand, I'm not sure. Like, maybe you as a firm could market to new small businesses, right? Sure, this is data from your competing firms' clients, but maybe you could try to market services to small businesses. And then on the other hand, though, I went to the Trade Desk website, and it looks to be a platform for big companies, right? I don't think our average listener and their smaller firms going to use this product from Trade Desk. So what this tells me is maybe one of the largest accounting firms could take advantage of this. So what's worse, Intuit marketing to your clients and stealing clients from you, or now big firms? Intuit's now made it easier for big firms now to find your clients and market to them. I don't know, the whole thing is like kind of weird, right? But it's the fear of cloud from the beginning with. The big 2 pushbacks on cloud was the IRS is going to access my data because it's in the cloud, or the data is just going to be sold like Google and Facebook and everybody else. And everybody was right. The data, your small business client data is now being sold to third-party advertising networks.
Let's talk about PwC and AI audit automation. PwC is saying that they're going to have full end-to-end AI automation for audits by 2026. It's
like 30 days from now.
Well, I guess the end of next year.
Oh, so, at the end of next year. Gotcha.
This was during a briefing at PwC's New York office. Sean Panson, U.S. assurance transformation leader, said end-to-end AI-driven automation should be expected sometime within calendar year 2026. This is according to Accounting Today. They are developing tools now for every audit step: planning, risk assessment, walkthrough, evidence collection, testing, and financial statement review. The goal is to integrate these AI tools into, quote, one global new agentic platform, unquote, expected within a few years. Some examples of AI tools that PwC has already deployed include simplified audit for private business. It's currently in use for audit planning. It's in its first year of deployment, and it auto-populates planning documents using prior year information. It helps auditors understand business changes since the last audit, and it was specifically designed for private company AICPA audits. There's also an advanced walkthrough assistant, which analyzes prior year walkthroughs and current documentation. It generates tailored work plans and highlights changes or missing information from the previous year, and addresses traditionally tedious audit tasks in large global organizations. There's also Evidence Match, which is an agent-led module for automatic evidence extraction and validation. It supports high-volume testing areas such as cash, accounts receivable, and accounts payable, and it's designed to handle multiple document formats and provides a clear evidence trail and documentation. They're currently working on a risk assessment tool that's going to help auditors make smarter scoping decisions, automated controls testing, an audit innovation hub, which is in pilot with asset and wealth management teams. They'll automate financial statement tie-outs.
So is any of this shown, or is this just talk?
So this was an article in Accounting Today. I can't see it, but they're doing a briefing for the press here.
Okay.
So there's
It's a
always,
show and tell at best.
There's always maybe a difference between the hype and the reality. But based on what I know about what can be done with AI agents and ChatGPT projects and custom GPTs, all of this is doable. Each of these little steps. Now, actually linking them all together is the challenge. But using, for example, AI to do audit planning, take the prior year information, auto-populate the planning documents for this year, that's a manual process that AI can totally do at this point.
Well, don't a lot of firms just do that? They just take the old one, change the date, and just use it for the next year and not even do the work? That's been the problem for a lot of...
Maybe, the AI agent
papers.
should be called Sally, and it just does exactly what was done last year. And that's the instruction set. Hey, just switching gears, here's a feature, a new tool that could help small firms a lot. And this is related to Google Workspace. So if you are on Google for your firm, not Microsoft 365, you have access to this now. Google Workspace now has shared inboxes. Multiple team members can now access, send, and manage emails from a single address, such as sales@company.com. I think this is actually one of the biggest wins that you can have as a small firm owner in 2026 if you don't have it, is a shared email inbox for your team.
You've always had to buy a third-party tool to do this.
Yes. And so a lot of small firms don't do it. And maybe they share access to a single email account, but that's not particularly secure. What you really want is individual logins with the ability to access a shared email. And this has been game-changing for us, David, with the podcast and with Earmark. We now use an app called Missive that does shared email inboxes, and we can have multiple different kinds for all different purposes. We have a shared inbox for sales. We have a shared inbox for production. We have a shared inbox for you and me as founders. And it's really great because our emails are no longer siloed in our individual inboxes. But setting up something like that is maybe a heavy lift if you only have, say, a handful of people working on your team. I think setting up a shared inbox like this in Google Workspace is a great idea, and it will help you as a firm owner or operator get out of the weeds and help your whole team have access. So you could set up a single email address inbox to do all your client work. You could have clients at firm.com, or you could use admin at firm.com, everyone shares access. And so all the client emails are going into one place. And then you could delegate them. Now, Missive lets you delegate them. I don't know if this shared inbox would let you do that. But in a small team, maybe you don't need that, right? Maybe it's just you and an admin.
You could easily use those labels. You could just assign them or
That
color
would-
code
that'd be
them. There's
smart.
all these things you could do.
Yeah.
Yeah. The
So-
real question is like now that Gmail's doing it, for this really to impact the accounting industry would be for Microsoft to do it in Outlook or Teams.
I don't know if that's possible in Outlook, but I think it would be great. Chris Kahn says Google delegated emails have existed for years, and Google Groups does the same with fewer features. Yeah, I've used Google Groups for this purpose too, but I don't like the interface. It's like they haven't changed Google Groups in years, and so this allows you to work within the main Gmail interface, which is way better, and still have shared inboxes. And welcome Heather to the live stream. Heather Smith says hello from Brisbane.
Hey, Heather.
Hey, Heather. Great to see you. All right. So let's do a few more pieces of app news while we're at it, unless you got something else, David, a little more.
The only one I don't want to leave with is we have to talk about Doge, your favorite
Okay, go for
government
it.
agency.
Let's talk about Doge.
Yeah. So Doge is done. So the Department of Government Efficiency, Doge, has effectively disbanded 8 months before its charter was set to expire. The Office of Personnel Management has quietly absorbed Doge's responsibilities. So they essentially, when it's all said and done, they cut through 300,000 government positions in the first 9 months of 2025. Obviously, lots of opinions on this. We got hate mails because of you saying it was kind of okay what they're doing. Then, the pendulum swings around on this a little bit. But I went to Doge's website. They have not posted any new, their wall of receipts they had on their website. There's nothing new since October 2nd and October 3rd. That was kind of the last time they've done anything. So either they're done saving money or they ran out of stuff to do, or it's probably something, my suspicion is, probably won't help the election. And I think some of the Republicans are cutting away some of this bad press stuff.
All right. I've got some career advice to take us out here, David. Given the tightening labor market for new accounting grads, or I should say shrinking job market, because the Big Four are cutting back on hiring entry-level people because of all this AI stuff, it's a real challenge now to get a job at this point. And I saw a data point that could be helpful to our young listeners. This was in CPA Practice Advisor, and the stat is that over half, 54% of workers, got their current job through personal or professional connections. So it's not going out and uploading your resume to a job site. It's not necessarily going to a career fair. It is personal or professional connections. That's how over half of workers got their current job. But only 60% of job seekers, or not yet, not only, 60% of job seekers don't use their network at all. Personal connections are the most valuable resource for job seekers. Professional connections are next. Job boards, they only worked for 13% of people. So if you're only applying to job boards to get a job, you're only going to have success 13% of the time. And why don't people network more? Lack of confidence is the number one reason. Now, here's a new way to network. According to a survey of thousands of US adults who used dating apps in the past 12 months, 1 in 3 dating app users are swiping for jobs, not love. This is also in CPA Practice Advisor. Yeah, so 34% of people have used Tinder, Bumble, and other dating platforms for career networking in the past year. And guess what? It works. 88% who tried this approach successfully made professional connections, and 39% actually landed job interviews,
That's
and 37% got job offers.
LinkedIn's the red water. It's the bloody water, right? You can't stand out there. But if you say on a dating site, if, hey, I'm looking for a job, there's nobody competing for jobs there. It's really smart, actually, to do that. It's the blue ocean.
Some users are apparently making their profiles look like resumes and targeting people at companies they want to work for.
It's amazing.
So think outside the box. You're going to have low likelihood of getting a job applying on a job site. But if you match, I mean, there's so much that's wrong with this. Like the HR folks must just be like, losing it. But
It's funny, but that alternative path in building a network is really a smart way. When every year I go and I do a talk, how to be a podcaster, right? Or an influencer at my wife's high school. And the advice I give them when people are like, well, what would I make a podcast about? And if I was a young person in high school and I wanted to become a dentist, make a podcast where you just go and interview dentists. They have egos. They'll want to join your podcast. Even if nobody listens to the podcast, when you're all said and done, you'll know 40 dentists. And when you finish school, you probably have a good chance of getting a job. Like it's a creative way to build a network.
Well, David, that's all the time we have for this week. Thanks everyone who joined us live. If you have not done that, go check us out on YouTube, search for the Accounting Podcast, subscribe, and hit that notification bell. You'll get notified when we
That's so funny.
go live. What's so funny, David?
Matt K in the comments asked if those are quote unquote legitimate jobs on your dating site.
This is unknown. I did not research this further. You can earn free CPE for listening today. Download the free Earmark app on the App Store or go to earmark.app in your web browser. You can get one free CPE every week for listening to this podcast and many other fine accounting, tax, and audit podcasts. And if you want to support our work, you can subscribe for the low price of $170 per year for unlimited CPE. So don't forget your year-end CPE requirement. Get that taken care of by listening to podcasts on your phone. You don't have to go to conferences or sit through webinars during your lunch hour. Get it done so you don't have to do it the week between Christmas and New Year. And David?
10% of you will wait till that week.
That's right. We had one more question here from Max, who says, Blake and David, what is your take on outsourcing talent? Is it hurting accounting in America, or do you have a globalist perspective? And that's an interesting question. I guess my take on outsourcing is that I see the impact on American jobs, right? It's the same trend of like outsourcing manufacturing that occurred in the 80s, 90s that hollowed out the middle class. At the same time, I don't know if it's preventable or if we want to prevent it, if there's anything we can really do about it. We use offshore talent. We have a global team here at Earmark, and we have maybe half the team, good chunk of the team here in the U.S. We got a good chunk outside the U.S. And the way I think about it is that we are just a global company. We don't have a U.S. team and a global team.
That's what I like about it too. They're just our team.
Yeah. And that's what a lot of firms are doing now. And I think the benefit is that, it creates economic opportunity for all, because the firms that do it right, they aren't just like outsourcing work and then firing people. I mean, there are firms that do that, right? The big four, famous for doing that. But I think the small firms that do this properly, or the mid-sized firms, are offshoring the work, and then that enables their U.S. team to do more, and to do more interesting work and to do different kinds of work, like a lot more client-facing work, for instance.
Well, I think it supports an entrepreneurial journey. At one level, yes, like massive. If like we're gonna lay off 100,000 accountants and go hire 100,000 people overseas, it's hard to argue that that's a good thing. But I think for entrepreneurs who are bootstrapped and they're trying to take a risk, it helps you take a less risk, right? Like it's a lot less risky for us to hire 6 developers overseas than to hire 1 developer and put our eggs in one basket. It's super risky for us to do that. So I think it helps entrepreneurs, small entrepreneurs do it well. I think for big companies, they're just doing it as a bottom line slash. They're looking at it we're not growing our team because we're using overseas labor to help us grow our team. They view it as like, it's just a cost cut. I'm going to change this line item on the profit and loss and change it to this number instead.
I think that's a great point, David. Thanks everyone who joined us live. We'll see you here next week. Bye everyone.